everyone. I'm Karen Yetter, Director of Marketing, and on behalf of Mercator Advisory Group, I'd like to thank you all for attending our webinar, Payments Modernization, Does the Future Lie in the Cloud? There'll be a Q&A session at the end of today's webinar. If you have a question during the presentation, you may submit it online by clicking on the questions panel. If we do not get to your questions, please email info@opusconsulting.com. I now present to you Tim Sloan, the Vice President of Payments Innovation and the Director of the Emerging Technologies Advisory.
Thanks for joining us here today. Sorry for some of the confusion around the start time. For some, we may have started a little bit early. For some, we may have started a little bit late, but we hope we can get the content out so that you understand the opportunities and advantages associated with cloud computing and machine learning. My name is Tim Sloan. I'm the Vice President of Payment Innovation here at Mercator Advisory Group and a founder of Mercator. And joining me is Gautam Nivsarkar, who is from Opus Group, a payment solution specialist. Opus is a technology service provider that's focused on digital transformation of retail payment systems. And Gautam is a data scientist at Opus Consulting, where he has implemented solutions that include chargeback prediction, merchant risk underwriting, cash forecasting, and other such solutions that are based on machine learning technologies. And Gautam, I welcome you.
Yeah, thanks, Tim.
The agenda for today will start with a review of how APIs that were once used primarily purely internally within an organization and ultimately started to integrate to business partners were literally set free with a new standard that enabled those APIs to operate more easily over the existing internet infrastructure, which has enabled new platforms, new solutions, and is the fundamental underpinnings of the PSD2 open banking initiative. We'll review several API use cases, including how APIs have established those new payment platforms, and then look at cloud computing and machine learning benefits, and then hear from Gautam, who has several use case research cases to be able to share with us in how Opus Consulting has implemented solutions. So we start off with what drives U.S. open banking and API adoption, and quickly explain what an API is and how Europe has been very actively driving APIs for their open banking solutions. So this model demonstrates, if you will, the way APIs originally came into the market. Up at the top, they were originally used for deployment model for internal integration. They were slowly adopted to be able to support XML middleware and became embedded in fairly complex SOAP known as Simple Object Access Protocol connection technology that enabled it to expand and be utilized in a fairly complex way with business partners. The deployment model 3 is more recent and is associated with the European Union's PSD2 open banking model. And then there's the deployment model number 4, the corporate client integration, where we see Wells Fargo, Bank of America, and other financial institutions using the APIs to integrate their back-end systems to their business partners to be able to enable new capabilities and also to be able to better integrate to those partners, making it less likely that those partners would be ready to move to another financial institution. The deployment model number 5 are the Open API Innovations Labs. You've probably heard these described as sandboxes where They can have hackathons and be able to bring third parties in to implement APIs against the existing back-end infrastructure of the financial institution, to be able to look for innovative new solutions that are coming from those third-party fintech suppliers. And then deployment model number 6, entirely new business models. And we'll talk a little bit about all of those. But first, let's talk about how integrating the APIs to the internet really set it free. And that was with a solution called REST, which enables the API to leverage all of the infrastructure of the internet. It utilizes the HTTP protocol, it utilizes the URL infrastructure, so that if I make an API available on my website, I can literally broadcast it the same way I would tell you to visit www.mercatoradvisorygroup.com. I can identify a similar URL that will bring you directly to my RESTful API and enable you to be able to see what capabilities I'm publishing, and it also explains how you can embed and use those APIs within your own solution. It's this capability of publishing APIs and enabling third parties to easily integrate to the APIs that is really changing payments and changing the way banking is being done, and will continue to make a big impact on the financial institution infrastructure. But obviously it's critical that resources be secured when those assets are put onto the internet. So let's take a look at how the EU, with its open banking initiative, decided to build an infrastructure that would enable the secure and safe opening up of the banking infrastructure. The open banking infrastructure created by the European Commission Payment Services Directive 2 became effective in January in 2018. It creates 2 legally recognized entities, and these are critical because they are the ones associated with vetting participants that will have access to the open banking infrastructure. There's the payment initiation service providers and the account information service providers. And these organizations, constructed by the EU and managed by the EU, has strict security compliance requirements that enable companies to become API enabled, to become a participant in that open banking infrastructure. And it's interesting to note that that means the security protocol, the vetting of who should have access to what, has moved away from the financial institution into this organization within the EU. It will be interesting to see if and when the first failure of this infrastructure happens, whether banks will really be relinquished of the liability associated with an incorrect access. But in theory, that's the way the EU has opened up that API infrastructure. And banks need to enable EU-identified third parties access into their systems. In addition, the EU has identified very specific use cases for those APIs. For example, a use case is in being able to make account information available, the latest transactions, etc., or being able to go in and make a payment. So the EU has not only defined the services infrastructure that maintains security, they're also maintaining the use cases that will be utilized by all of the participants to be able to gain access to information. The ultimate aim is to increase competition and lower prices for customers. The US doesn't have this type of infrastructure, so financial institutions here in the US tend to still be working with their corporate banking customers, where the bank is identifying who the API should be opened up to, and is also defining the use case for those APIs, which are very often less to do with the account infrastructure and more to do with business banking. So now let's take a look at US API use cases. One of the more interesting events that have occurred in the US market is the recent introduction of payment platforms. This slide shows 6 different payment platforms that have shown up in the recent past. Push Payments, Marqeta, Fiserv, Stripe, Finix, and Hyperwallet. I would actually add Green Dot to that as well, who's also taken their prepaid platform and turned it into an API-driven payment platform. But it's interesting to see how each one of these entities came from someplace else in order to establish a new payments platform. There are some new entrants that literally created the platform specifically to develop a payments platform. But then there are those such as Fiserv, who had a banking background, who opened up their payments infrastructure designed for banks using APIs. Stripe and Marqeta, who were more focused on merchants and opened up those merchant interfaces with APIs to enable a payments interface. And Green Dot, who took their prepaid platform and opened it up with APIs to be able to establish the solution that powers Apple Pay and also powers Uber for their payout. So that's one example of how APIs here in the US have established new business models despite the lack of an overarching security and access control mechanism. I think perhaps even more interesting than those payment platforms are initiatives that used APIs to create entirely new products and revenue streams. This slide shows on the left Visa, who introduced a set of new capabilities to the financial institutions they serve by partnering with ThreatMetrics, Dayon, and others along the top in order to, and they've integrated those into their Visa Development Center, and then they're making those services available on the bottom to their existing banking customers. And the idea here is that Visa will be the one who actually services and bills for these third-party services that are integrated to the Visa Development Center. This is part of the Visa ID Intelligence product set. And it's also interesting to recognize that existing between the third-party suppliers and the financial institutions on the bottom is the opportunity for Visa to create some value-added services that cut across all of their partners at the top and across all of their financial institutions on the bottom, using machine learning and other tools to add value-added services to everything that they do. Mastercard on the right-hand side is taking their regulatory structure, their ability to identify financial institutions, to be able to have a dispute resolution mechanism and the rest, in order to create an open banking product set. That product set can be used in Europe, or it could be used here in the United States. But again, they saw the opportunity to identify those trusted entities that are already part of the Mastercard network to help those companies come in and provide open banking solutions. Another capability that Mastercard brought in was they acquired a platform called Vise, which is enabling a payments platform that enables instant loans to be created in a marketplace so that loan originators can make offers, merchants can accept them and make those offers available to the merchant customers. it'll be interesting to see how that plays out in the longer term, but it was very simply done using the API infrastructure that VISE had already executed on. So on the next slide, we take a look at other opportunities to monetize open APIs. There's the newer payment systems such as same-day ACH or RTP from the clearinghouse. They're coming into the market, and it's likely these will create new opportunities for platforms, either within the existing payment platforms that we talked about earlier, or perhaps entirely new platforms that provide services for these new payment infrastructures. New services that might include chargebacks and dispute resolution, purchase protection and warranties to consumers that are using the faster payments so that banks could more easily provide those protections and warranties. They could offer rewards and offers on top of the networks or credit lines. So the API infrastructure and platforms enable new services to be brought to market quickly. They also allow existing service providers to unbundle and rebundle the solutions that they have already in their back end. So that this is what Visa did with their authentication API. They've taken that and broken it out and made it available to financial institutions as a separate capability under their new service. Third-party payment providers may be able to access security and fraud prevention features. Retailers that are looking for a means of integrating rewards and payments are now enabled to be able to use these unbundled features, take them apart, offer them to new customers, and then bundle new capabilities in with third parties to make something entirely new. Additional use cases for these APIs could include secure account aggregation, data access and compliance, budgeting, purchase affordability, and these all fall under the rubric of a personal financial management type solution on the far left-hand side. Can provide balance monitoring and alerts or other capabilities that tie into your financial institution's account holders' needs to better know what's going on within their financial life. It could also be around financial service delivery, payment sending and receiving, being able to enable new corporate payment solutions for paying remittances, tying into networks such as Ripple to be able to lower the costs for international remittance. There is a range of capabilities that can be brought to bear once your organization has identified and started to use these APIs and capabilities. I'll stop there for a second and see if, Gautam, you have any thoughts on any of that?
No, I think you've covered it really well, Tim. I think we are now able to understand how APIs have, grown and how their acceptance and so on has been used by multiple industries and regulatory organizations as well. Thanks.
Yeah. So let's take a look at the cloud. It's interesting to note that financial institutions have been a bit stymied by the cloud. Our research indicates that they really understand the potential benefits and that they see broad adoption in other industries, but financial institutions remain worried about security, and they're really having a problem finding a clear migration plan that would enable them to take their existing systems and move them to the cloud. The benefits, of course, are pretty obvious. You're able to take a large system cost that is capital equipment and fixed and turn it into a variable cost that changes based on the level of activity that's taking place on the platform. And the platform becomes infinitely variable, infinitely scalable. So if it is done properly, as you get a rush of new customers, as payments increase during the holiday season, the cloud platform enables those systems to scale very rapidly. So you're able to reduce fixed costs, actually eliminate fixed costs, and turn everything into a variable cost. The hardware, and that includes all of the hardware costs. And it enables the back-end systems to start to be broken up into microservices that have APIs for internal or external integration needs. But of course, the primary concern remains security and a lack of trust associated with the cloud. So let's take a look at the results of some interviews Mercator conducted the end of last year with 14 institutions under $5 billion, where we collected their insights on how they perceive the cloud. This list is supported is sorted by revenue. So at the top you have the largest institution we talked to, a $5 billion institution, and at the bottom you have the smallest of the 14 institutions we talked to at a little under 200 million. And you can see that these are both community banks and credit unions under bank structure. If you take a look under current cloud adoption, you can see that it's not really well correlated. Where they are is not well correlated to their size. In fact, the credit union 11 with 491 million is the only one that has currently already moved some of its core capabilities out into the cloud. You also have a credit union at just 300 million who has already many non-critical systems in that half a Harvey ball already in the cloud. And you can see that that's true also with Bank 10 at 495 billion, as well as in the larger community bank at 4 billion. And yet, between 4 billion and Bank 10 at 495 billion, there are a range that have very few even non-critical deployments happening on the cloud. What shifts very rapidly is when we move from what they have done to their attitude about moving to the cloud in the near future. And there we can see that the benefits of cloud computing are indeed well understood by all of the interview participants for the most part, and that there is an expectation by a large number that they will be moving to the cloud in the near future. And if they're not already planning or expecting to move to the cloud, they certainly would implement it if they can figure out how to get their resources aligned with that particular goal. So that was specific to their interest in cloud computing. We also have done a survey looking at machine learning in some of the largest financial institutions in the US, where in the report, 70+ processes banks have already improved with AI. The report took a look at both popular literature that already had some announcements about use cases for machine learning within large institutions. And then we also did interviews with those large financial institutions and discovered that 13 different business units have already implemented more than 70 unique business processes using machine learning tools. They're using it to improve authentication and onboarding processes and to reduce fraud rates. They're using it to monitor card operations and improve their risk management. They've created new customer service channels and improved agent response to those customer service issues, including Bank of America's Erica, RBC, RBS, NatWest, and the rest. They are looking to use robotic process automation to reduce labor for repetitive operations, such as validating forms and checking third-party databases for accuracy. That's across Amex, BBVA, Deutsche Bank, and Walgreens, Walmart, and better predict activities and products that customers want. So the financial institutions, the larger financial institutions, have all made significant investments in machine learning and continue to expand how they intend to utilize machine learning going into the future, and have indicated high interest in understanding how to deploy it further. When we map that to the interviews that we conducted, you can see that credit union number 11, with only 491 million in assets, has already implemented AI, and in fact found that that AI solution was so competent that they're actually starting to resell that application. That is highly differentiated, of course, from most of the other financial institutions, 5 billion and lower, most of whom don't even know who inside their, well, 4 of which don't even know who inside their organization should be planning around machine learning. And most of the others say that, to their knowledge, no machine learning has been implemented. Now, I'll tell you that's probably inaccurate. It is almost certain that all of these institutions have some machine learning tools already deployed within them, available through third parties. So whether that's a solution from threat metrics that's looking at how users are coming into the website, or other solutions such as Salesforce that has Einstein built directly into it, it's almost certain that they have got machine learning tools already deployed. It's just it's so tightly integrated to the vertical solution that they operate that they didn't even know machine learning was built into it. Yet, when you take a look at their intent to deploy machine learning, it's also clear that most of them are pretty well aware that machine learning is having a major impact on our industry and represents a significant opportunity to improve their operational status, to lower their costs, and to become more effective at integrating to their customers and meeting their customers' needs. And so it will be interesting to see how these smaller institutions respond while the larger institutions continue to make significant investments. And with that, I'd like to pass this session over to Gautam to talk about some of the implementations that Opus Consulting Solutions has implemented in the marketplace.
Yes, sure. Thanks, Tim. Thanks for the very insightful overview that you have given to us. And I'll continue on the same lines to just give you an idea of how we at Opus try and implement these solutions in the form of multiple projects and POCs for our clients. So I'll start with machine learning. So we have tackled a wide variety of machine learning use cases here. Anyone who would have read about or worked with machine learning would know that there is absolutely no shortage of algorithms or tools present in the market. The crux would be to apply it while focusing on two critical aspects of, say, relevance and usability. So this slide actually focuses on the relevance part. Just to give you a small introduction, machine learning algorithms can be broadly categorized into two types, which is supervised and unsupervised algorithms. So supervised learning caters to a set of business problems wherein models are trained to predict a particular value, say whether a transaction is a fraudulent one or no, or what would be my cash requirement for the next 3 days, and so on. So that's the first two blocks on your left that you can see. For supervised learning as well, we have two broad classifications. The first one, in fact, is called classification, where we can predict whether a particular data point belongs to a specific class or category. So this we have With these algorithms, we have tried to implement use cases like, say, fraud detection for the remittance industry, or AML transactions, anti-money laundering transactions. So, and we have tried to address it using multiple factors like transactional, demographic, and geographical factors in the historical data. Uh, we've also tried to identify transactions which are likely to result in chargebacks for merchants and acquirers based on historical incidences of chargeback transactions and customer behavior. We also tried out automated rule generation and transaction filtering for reconciliation activities, and this has been done on multiple and disparate data sources and files. Moving on, similar to classification, there's also a family of algorithms for regression. The main difference is that the regression typically predicts or gives you a continuous output. So, this helps us with use cases like merchant risk underwriting, something that Tim mentioned earlier, wherein, the merchant risk is assessed by acquirers using historical financial or transactional performance data of the merchant before actually onboarding them. Or, for your ATM operators or, financial institutions, we can actually predict the cash demand at an ATM, and so that it's replenished on time and there's a less chance of a cash out scenario. We've considered elements and data points like daily, weekly, monthly seasonalities, the impact of weather conditions and demands, and so on. uh, Another interesting use case is also with respect to the predictive maintenance of ATM equipment to minimize the downtime and try to solve the problem before it actually happens. Yeah. So, this was with respect to supervised learning algorithms. We have also, implemented a couple of unsupervised learning algorithms like, you know, analyzing the user behavior at the ATM, something similar to what e-commerce companies do with their clickstream analytics, and also try to segment customers for recommending the right set of products or services. So now this takes care of the relevance part, how ML algorithms are, or rather can be applied to multiple payments use cases in the industry. Now, the second most important part is also with respect to the usability aspect. So if you can move on to the next slide. No. So again, no machine learning model is relevant unless it is applied in a real life production system or a real life scenario, and it can be actually used by client teams. So this is the way we typically do it now. This is a very generic approach where the advantages of the tools and the platforms that are present today is that the system or the platform on which you train a machine learning model, and the platform on which it is actually being deployed can be different. So these trained models can be exported out of the analytics system, like I've shown in the diagram, and they can be exposed as API or web services. Now, your actual end user client applications can then integrate or consume, if I may, these web services, and then use them for your real time or batch predictions as required. Now, just to complete the loop, these the data being generated on a daily basis can then be sent back to the model for retraining at fixed frequencies to keep the models and the learning relevant, and to maintain the accuracies and keep them up to the mark. So this kind of gives you a fair idea of how machine learning is being applied in the payments industry, and how machine learning models are being deployed as APIs for easy consumption at the client side. Now these are, yeah.
Yeah, I just want to highlight that exact point. I think there's a large number of companies and institutions that think they have to implement the machine learning platform on their own, which can be daunting. Complex data scientists, the investment seems just overwhelming. When in reality, the way machine learning is being deployed is more in the cloud. The data scientists and the solution providers work to establish the solution, make sure it works, and then embed that solution into the cloud so that the institution can access that solution from any place, greatly reducing the hardware, the software, reducing all of the infrastructure that's necessary to operate that machine learning solution because it's done in the cloud. I think it's an important consideration.
Yes, exactly. It widens the range of use and makes it available. You can productionize it very easily, and a lot more companies and people can use it for their benefit. Yes.
Right.
Yes. So again, just to continue on the same lines, these use cases that we saw from a machine learning perspective were specific individual use cases. Next, we'll take a look at a couple of enterprise level solutions that Opus has built for the payment industry using these digital technologies. So if you can move to the next slide, please. Yeah. So, we'll take a look at the merchant management system or solution that we have built. Uh, One of the critical challenges which is posed for acquirers, PayFacs, and ISOs is effectively managing all the activities associated with different stages of the merchant life cycle. You'll be able to see those different stages to your right. It begins with merchant onboarding, which covers data capture, profiling, and underwriting. Then you go on to commissioning and fee management, provisioning, transaction and risk management, settlement and recon, disputes and chargeback, and finally, you have your merchant help desk and self-serve centers. Now, most acquirers today possess multiple systems, which they together term as a merchant management system. Now, there are to handle them, there are different processes and activities, and they are present on very different, disparate, and legacy systems. There are multiple internal teams and external vendors who are actually managing them. Now, this brings about a problem with difficulty to operate, maintain, and upgrade the systems. The integration costs associated with them are also high, and there's also redundancy. There are multiple systems would have the same processes present, so there's a decision-making problem and so on. So what we have tried to, with our experience with in the payments industry, 20 plus years of experience in the payments industry, uh, that we have gained with, working with multiple acquirers, merchants, and card networks, we understand all these problems at close quarters. We have seen them. So we've come up with an enterprise level solution which addresses, all of the above challenges with the existing systems. Now, the solution is cloud native, so that new customers, who are primarily acquirers, can quickly get themselves onboarded and start using the solution. The framework, we have kept it technology agnostic, and so that it can satisfy a wide variety of implementation requirements from the clients. Now, just to focus on the APIs and microservices part that we are discussing at a broad level in this thread, the microservices-based design enables different modules in the MMS to be exposed to different clients as individual offerings. So we can use this architecture to cater to a wide variety of enterprise clients. Wherein the larger enterprises can use the entire product or the entire system with all its modules, while the smaller SME level firms, they're either focused on some niche areas or they're on the growth trajectory. Can pick and choose models which are relevant to them and based on their commercial and functional requirements. So, just to sum it up, the MMS solution is a very good example of the internal integration as well as the corporate client integration applications of the API use cases that Tim was talking about earlier. So it helps us, Opus broaden our range of offerings to a wider gamut of client profiles, and in turn also helps our clients with their specific needs. So
also provide you nice reusable components that you can apply to the next problem.
Exactly. Yes. So we'll move on to our next enterprise level solution. You can go on to the next slide, please. Yeah. So we are looking at the Opus voice bot. So now we are all aware how conversational commerce is steadily making inroads into all your multiple industries, and it basically helps financial institutions to quickly achieve scale for their offerings to large client bases, but with a fraction of the cost, a fraction of the incremental costs. So, what we have done is we have built this bot, but we have chosen to remain very specific to the payments domain, and we have chosen to retain intents contextualized only to the relevant use cases for payments. Now, similar to our previous offerings, the bot, that's what I would like to highlight here, is that the bot uses open banking APIs for its fulfillment requirements at the backend. So as Tim mentioned, it's being steadily growing. The use of open banking would be steadily growing in Europe now. So as more and more banks start adopting to these standards, it would be very convenient for them to integrate such bot-related offerings with their backend systems, and also start reaping the benefits of it. Yeah. Now, in addition to the open banking APIs, the bot also has a number of other capabilities, like storing and retrieving multiple conversational context, which will ensure a more human-like experience in their conversations, or a seamless and uniform experience across a host of channels, like your web, voice, mobility platforms like Android and iOS, Facebook, as well as with devices like Alexa and Google Home and others. Uh, with all this, we've also ensured that we retain the security aspects and confidentiality aspects of the data. We're using two-factor authentication and PII, or personally identifiable data masking. Uh, uh, on the same time, we've also tried to incorporate features like live agent routing, logging, and monitoring, and these would mainly be for your quality and audit related purposes. Again, going back to Tim's point, conversational commerce is another example of open banking, as well as the corporate client integration aspects of the API strategies that we saw earlier. So again, just to conclude, yeah, sorry.
I love the idea of your voice bot using the open banking APIs. Means you could integrate to, say, Mastercard's open banking platform and be able to bring a voice activated bot directly down market to Mastercard's smaller financial institutions.
Exactly. That was the main aim behind using open banking. Yes, exactly.
Very cool.
Yeah. So again, these are just some examples of how we use digital cloud and API-based technology solutions to cater to enterprise needs, and how our clients and enterprises are using them to either regulate costs or increase their client base and revenue, or even simply stay relevant and stay in the race with their competitors. So that's it from my side. Thanks, Tim.
Thank you. That was great. Karen, do we have any questions that came in?
Yeah, so we have a couple here. What is the typical time frame for implementing such digital solutions for clients?
Well, I'll bet you that's going to vary a lot depending on what the solution is, but Tom, you want to take that?
Yeah, sure. You've perfectly said it, Tim. So it typically is a function of multiple factors, client readiness, how the existing legacy systems are built. But the way we tackle this problem, we recommend our clients to start small and think big kind of an approach. You can begin such projects, such DT or digital transformation projects, with a short-term POC. It can comprise of say 3 to 4 sprints, and the time frame typically varies between say 8 to 12 months, and then check for its effectiveness. You can have the most tech-ready team to work on that use case, and then the entire team and the upper management can get a fair idea of what the real-life challenges are associated with the implementation can be. and then can be ready to take an enterprise level decision of going the big bang.
Yeah, and I wrote a report 2 years ago, Machine Learning 101, basically, and I suggested that it is highly likely that machine learning will ultimately be pointed towards APIs themselves in order to help lower the effort associated with integrating to those APIs and to be able to monitor the APIs for normal usage or any problems that might occur. And I've already seen a couple of solutions in the market that are starting to do that. And then there's the ability to use machine learning to explore a financial institution's silos to discover specific data that's necessary to bring one of these solutions to market. And that is a little more rare, although I am aware of at least one supplier that's done that in the prepaid space, where knowing what data they're looking for, they can have a machine learning tool that actually goes out and finds the appropriate data and puts it into a repository. So machine learning by itself will simplify.
Okay, the next question, how do you judge the effectiveness of such digital transformation projects?
Ooh, KPIs, I guess. You know, well, the time you want to take it, I would think for any project, and especially one of these projects, understanding what your goals are is critical. And then those goals will drive the development. But what are your thoughts?
Yeah, that's a very good point. So, although you might have those KPIs, but it could be a combination of multiple factors. Cost considerations, the time limit, what are the actual tangible business benefits that my employees or my clients are deriving out of the out of this out of the project and so on. But I can give you an example of machine learning, for example. There typically is a trade-off between factors like your model accuracy, how accurate is my prediction, the time taken to train the model, and the resources that I'm spending on training the model. So if I'm using, say, my cloud resources for actually uploading tons of data on the cloud and using expensive resources to really train my model and spending hours to train, then the cost that I'm incurring in actually training the model vis-a-vis what is the benefit that I'm getting out of the predictions. So such things could be taken into account, through a POC or a proof of concept that I explained, and then uh, the clients can take a decision. What is their priority as of currently, and that's how you can really come arrive at the effectiveness.
Yeah. So, right, it's relatively simple when you know what it is you're going to be building and what your goals are, but still requires an understanding of the implementation. I think we had another question come in. Are digital transformation projects only applicable to large enterprises? Boy, I would have hoped my chart of the small institutions that have already implemented some of the machine learning tools as well as cloud-based solutions would suggest it can go pretty substantially down market, especially when those solutions are based on cloud computing. But what are your thoughts on that, Ketan?
So that's perfect. In fact, the survey results actually spoke for themselves that it's equally applicable to both small, large, as well as small and medium scale enterprises, no matter where you are on your growth path or growth trajectory. And in fact, our entire gist of our conversation, exposing these APIs as your code as microservices, and modularizing them and so on. These actually help your smaller firms pick and choose on which of these offerings are priority to them, and which they can afford as well. And think small and rather start small and then think big. So definitely it's applicable to all, an entire range of enterprises.
And I'd say some of the smaller institutions are likely to find that they will be driven to evaluate new technology through their partners such as Visa, Mastercard, Amex, more specifically Visa, Mastercard, who are introducing machine learning in the behavioral biometric tools that they're releasing within 3D Secure 2.0 that collects data and forces us to do risk-based analysis on that payment transaction. And so in part, we're being driven by the networks and the merchants who really need to cut off e-commerce fraud and are deploying machine learning tools to do just that. But those machine learning tools need to also be integrated into the financial institution to be effective. So I think, every institution will be on a trend line towards implementing machine learning. And again, they may not even know it as that. They may know it as the ACS server provided by Mastercard for 3D Secure 2, but it will be machine learning based.
Yes, yes, very, very good point. Very true. Yes.
Okay, so I think that's about it for our time today. So thank you for participating in today's webinar. There will be a recording available, so if you missed some portion of the webinar, we will be sending around a link for everyone who attended the webinar today. We apologize for any inconvenience on the timing of the beginning of the webinar. If you have any specific questions or would like additional information, please email info@opusconsulting.com. And thank you for attending. This now ends our webinar.
Goodbye, everyone.
Thank you.